Well, across most countries, inflation has surged, which is reflecting strong consumer spending, supply chain bottlenecks, and commodity demand pressures. There are two key risks. Firstly, there is the worry that high inflation could cause a slump in growth if surging raw material costs cause firms to cut back their production and cause households to postpone their spending. A more significant risk is whether economic activity can withstand tighter monetary conditions and higher interest rates that will be needed sooner rather than later to keep inflation under control. Economies should be able to navigate higher interest rates and inflation provided policymakers communicate their intentions clearly to markets and tighten policy slowly. Economic activity should not be stressed too much provided productivity and investment growth remain strong. Well, the key signpost for investors to watch will be how markets price in interest rates and if productivity growth can remain strong. Policymakers need to make sure that they are not forced to tighten interest rates by too much too fast. We've already seen significant upward revisions to global growth expectations, and markets have priced in a lot of good news already. So what that means is that the overall trend into the second half of the year is likely to be robust returns that are above average but are slowing down as growth continues to ease and as liquidity tightens. We believe that this Goldilocks environment can persist for a while for investors, but over this transition period where inflation is rising and monetary conditions eventually tighten, there could be bouts of significant volatility. Growth assets, especially equities and real estate, can give relatively better real returns in an environment where inflation is rising. Well, some of the key trends that are likely to continue to drive positive long-term returns from equities include greater digitalization, which is helping drive up corporate margins. We have the green engine and sustainable investing, and of course, rising middle-class consumption spending. Given these key trends, we remain positive on sectors like consumer products, IT, communications, healthcare, and renewables because they do seem well placed to navigate the post-COVID-19 environment and grow their market share.